Hi, I'm Daniel Schwartzman, Director of the Seagamble Marketplace. We're continuing our video roundtable series with Michael Gayed of the Lead Lag Report, as well as Portfolio Manager of ATAC Rotation Fund. The Lead Lag Report is a service that aims to anticipate corrections in volatility with award-winning research. We're obviously in a volatile time, so good time to speak. Morning, Michael. How are you doing?
I'm good. I appreciate it.
So let's just start. We did a recent roundtable, and one of the points you made was that, which seems actually quite on point, valuation is largely unknowable right now. It's really hard to say what the earnings is on which you can make a multiple. And then it's even harder to bet on it because we have all the stimulus going on. So, given all that, how are you orienting yourself?
Yeah. So look, I think anybody thinking that they can tell you what valuations are going to be here are probably fooling themselves realistically. This has been an enormous deflationary shock, right? Aside from the health aspects of this, stay at home is ultimately about disinflation, deflation. That's why the Fed is doing everything it's doing to be ultra aggressive. So I think the way to really view the environment that we're in is not as one that favors fundamental analysis the way we're maybe used to, or passive buy and hold investing the way I think most people are probably used to, but more in terms of this kind of construct of, what will win in that tug of war? Is it going to be the Fed, fighting out of deflation and creating a reflationary environment? Or are we in this kind of perpetual period of lower rates and disinflation, deflation, higher volatility? I think most likely it's more the latter, meaning that I suspect that, the Fed came in here because they recognized that, as I had been arguing on Bloomberg and some other media sources in the midst of the decline, that this is a potential capitalism reset if the market were to keep going lower and lower and lower. As the stock market was collapsing in those weeks of the coronavirus crash, a lot of people were saying, the market's got a lot lower to go, and people were saying that because you've had prior instances of major drawdowns of 50% or more, and didn't have that type of a move just yet in the equity market. The problem I always had with that is that, yes, you've had historical examples of major declines, but never against the backdrop of 0% interest rates, never against the backdrop of all of this tremendous debt in the system, never against the backdrop of so much reliance on the stock market for the wealth effect.
Hmm.
And when you think about it from that perspective, more in terms of sort of the system surviving or not, it makes sense that we saw the Fed do everything that they've done, things they have never done going back to the financial crisis, which makes any kind of earnings any kind of fundamental analysis almost moot, because we're at a juncture in history here where it's purely about that macro question: inflation, deflation. If deflation, can the system survive? If inflation, can companies, then survive, with the Fed backstop to keep this thing going?
Okay, so that's a pretty stark juxtaposition. You had mentioned that this is a tactical market as a sort of follow up to that, and so I guess within that context of trying to figure out where we go, that's where the tactics play out. But what do you mean when you say this is and tactical is a big thing for you? But what do you mean when you say it's a tactical market right now?
So I think that it's important to distinguish between tactical and market timing, right? So market timing doesn't work. I'm not a fan of the idea at all. And the reason market timing does not work is because in all the studies around market timing, it's a decision of either the investment, usually stocks, or cash as the alternative. I am not a fan of cash as an investment option. And I'm saying that because the problem with cash, and which is why market timing doesn't work, is that with cash, you have no chance at momentum. You have no chance at making money. It's a binary decision. Either you're exposed to something with risk or exposed to something with no risk. Whereas if you're tactical and you say to yourself, okay, how do I benefit from conditions that favor stock market volatility? You don't do it necessarily with cash, but you do it with something like treasuries, something like gold, maybe some kind of currency pair that can benefit from a risk-off environment. That's how you really take advantage of an environment which is not just about passive beta buy and hold, right? So when I think about tactical, it's not sort of a question of in stocks or out of stocks. It's which asset class for that moment in time, given conditions that change week to week, which is a lot of kind of where my focus is on the lead lag report. And I think this is kind of a very important way to think about the world that we're in, the world that I think we've always been in, but now it's more obvious. Listen, this is an industry where everyone has to make forecasts. Everyone has to be able to tell you, here's where the S&P is going to be by end of year. Here's what oil is going to be. Here's where what the Fed's going to do. The reality is nobody has any clue about what tomorrow brings. The best I can tell you about is the weather. Right? I can tell you the conditions that favor an accident in markets. Now, a lot of my work is centered from a tactical perspective around these leading indicators to the conditions. I co-authored 4 white papers that won 4 separate awards, 2 from the CMT Association, the Dow Award, 2 from the National Association of Active Investment Managers, NAME, the Founders Award there. And all 4 papers I presented on all over the country. And they're all about tactical, right? And the findings are all kind of similar in the sense that there are leading indicators to risk, to conditions that favor an accident in markets that you can follow to determine whether to play risk on in equities or risk off in treasuries. It's really a key component to the lead lag report, which is available on Marketplace in Seeking Alpha. The reality is I don't know what mile marker I might crash my car when I'm driving. I have no clue. But I know when it's raining, I know I need to slow down entering the storm. And I think that's sort of the mindset investors really have to have here. Rather than thinking so much about individual security selection, I think the sort of macro environment of whether it's raining or not and following leading indicators that tell you the weather, that's really how to kind of view the marketplace. The final point I'll kind of put to that, which I think is also important. Passive buy and hold has obviously worked and works over very long periods of time. But I think it's important for everybody in this business, any investor, to recognize that buy and hold is a strategy no different than any other strategy. Meaning there are times when it works, there are cycles which favor it, there are times when it doesn't. This is probably a cycle where it doesn't, where yes, it makes more sense to be a little bit more proactive trying to manage risk. For years, the market had no risk. Every time the market went down, it went down for maybe a blink of an eye and it shot right back up. So you never really needed that desire or that ability of diversifying across strategies as opposed to just stocks and bonds against different things that can benefit from different paths in market movement. Now I think this is a reminder that, as we've seen, 3 weeks can take away 3 years of gains. Magnitude often matters more than frequency. You've got to be tactical and think differently about your portfolios. So it's not just about buy and hold. It's about a mix of things that can expose yourself to multiple unknowable futures.
So I want to follow on a specific part of that, which resonates with me. The idea of cash is not binary, or is binary, and doesn't get exposed to beta. I have, for example, still the largest chunk of my portfolios are in short-term bond ETFs, right? So not a lot of activity there. More activity than I expected over the past few weeks, but still pretty stable. The question is, if you're talking about, let's say, gold or treasuries, there's still that behavioral need to follow the indicators and to switch allocations. I guess I'm just curious why that you view that as a little bit more feasible for investors or attractive for investors as compared to the optionality, let's say, of cash where you can buy anything.
Well, first of all, I think, especially in a no commission trading world, even if you're in short duration treasuries, which I would not argue is cash, there's cash-like, but there's still momentum potential there. That's still a better risk-off trade, right? I think the point is that ideally, when you think about the opportunity set for investments, you want to be able to express an idea of being negative on markets or betting on higher volatility, but still be able to make money when you're wrong. Which kind of goes back to this point about forecasting. Nobody can predict the future. You can identify the conditions that favor the accident. You don't know the one mile mark. You don't even know if you're going to crash, but you slow down. So from that perspective, I think the right way to really view it is, ideally, if you're going to express a risk-off trade, you want to be in something that has some yields that can be safe, because time is on your side, so that if you're wrong, you're still potentially making money because of the yield component, right? In that moment in time, time is on your side. If you're right, and you get that sort of inverse risk-off correlation, which typically happens in treasuries, like what we just saw with yields dropping on the long end and stocks dropping at the same time, then you really sort of benefit from that trade. But it's really important, I think, people get obsessed with, being right or wrong. You want to be wrong and still be able to make money, right? And I don't think cash gives you the option to do either of those.
Okay, fair enough. So if we're using the I'm not going to get the metaphor quite right here, but with the weather analogy, you have to think about the Fed, which we've talked about, well, and the fiscal environment is creating a lot of weather to try to, as you said, prevent deflation, prevent things from falling off a cliff. You've been fairly critical of them, and I don't think this is the first time that you've critiqued the Fed, but I'm curious to hear a little bit more on what you think is the problem here, especially given this is somewhat of a unprecedented economic shutdown. So, what are your thoughts?
Yeah, so look, I mean, to be clear, I'm not an anti-Fed guy by any means. In the midst of the decline, I was doing a segment again on Bloomberg, and I was saying at the time that perversely, this is an environment when you want to have a Federal Reserve, you want to have a fiat economy where you can create dollars out of nowhere. Because when you have a pandemic that's suddenly out of nowhere and nobody knows the extent of how serious it is, you kind of need to literally give dollars. You kind of need to socialize. Otherwise, you do have societal upheaval. If you don't give people the ability to even go out there and shop, then you've got something much more serious than a pandemic. You've got, again, I go back to a system reset. So my issue with the Fed, I think, is that it distorts, and I think a lot of people intuitively know and agree this, their intervention distorts, free markets. You can't really argue that we have a capitalist system only one direction when things are going up. You have to allow losses to occur. Otherwise, you end up having a Japan-like scenario where you have a number of these zombie companies that, probably would go under if it weren't for Fed action on the macro side. And I think that has a lot of very dangerous implications on incentive systems. First of all, the fact that the Fed basically said we're going to come in and buy, corporate and junk debt ETFs, to me, while I understand the reasoning, to me sounds very, very reckless. Because if you're backstopping risky junk and making it no longer junk, but instead AAA, because the Fed's got your back, in the name of trying to keep credit spreads tight and make sure that it's not a recession or depression, you're inherently also rewarding those companies that never really should have survived to begin with, because they made reckless debt decisions to begin with, or because mega trends would not allow them to survive anyway. I think there is a very real argument to be made here that what's happened with coronavirus is it's accelerated a lot of these mega trends and made them come sooner, right? The sort of work from home trend has always been there. Seeking Alpha editors do it. I run a mutual fund. I write the lead lag report. I'm doing things remotely as well. It's not uncommon to me. And now everyone's realizing in multiple industries you can work from home. That's a trend that was happening no matter what. It just got accelerated. Restaurants, it's horrible what's happening, right? I mean, I have very good friends that own restaurants, and they're suffering severely in this. But there have been arguments for a few years here that in 10 years, you may not see restaurants in the same way that we're used to. Why? Because you're going to have these ghost kitchens where people are ordering from Seamless and Grubhub and all these other places and just getting delivery from these centralized places where there are chefs, right? So, and we're seeing that because now more and more restaurants, obviously because they're not open, are delivering. So there are these mega trends that just got accelerated. But if those mega trends were going to result in these zombie companies not surviving, why are we propping them up here in the name of a pandemic? That's really sort of more my contention with the Federal Reserve. I think there have to be limits. And at the end of the day, if as individuals, we should have some rainy day fund, 3-4 months of living expenses to survive something like this. Why can't we have the same requirement on companies? Why is it that these companies are allowed to do buybacks for years, taking away their rainy day reserve, to then ultimately say, okay, great, now when things really get bad, the Fed is just going to give you more money and keep you in business and keep spreads low and keep lending. I just think that it's very negative for a system longer term. I understand the shorter term. Again, I'm not an anti-Fed guy. I just think that there are unintended consequences with every major action. And now that they've set a precedent to do this, why not do it every time there's a recession? I mean, where does it stop? Where is there a limit to that? I can make a very clear case to you that the Fed basically stole returns from high yield investors, because 2, 3, 4 weeks ago those yields were looking great. Everyone's hungry for yield. It's not like you would have had every single junk debt company go under. Of course not. There would have been opportunities to do analysis, security selection, make money, from those high yields. And great, that's what retirees want. They want those opportunities to capture those high yields in a world where everyone's been hungry for yield. The Fed took that away very quickly. I have a problem with that.
So I'm just interested in the topic. I want to go a couple things here. First, how do you distinguish the Fed's monetary stimulus from the fiscal stimulus? Like, do you feel that
No.
the various fiscal programs are causing the same sort of moral hazard, or do you feel that there's something different in nature or degree about them?
Yeah, so I think at this point, and I've been saying this in the lead lag report quite a bit. I think the fiscal and monetary side have become one and the same. And the reality is, you kind of need to. Part of, I think, a way to kind of restart things is, what Trump is arguing he'll do, which is, do this infrastructure spend that's coming. There's no appetite, for the government to just do another round of bonds, let alone very long duration bonds, like 100-year bonds, because no one seems to think that in 100 years, rates this low will be justified. But the Fed can buy them. The Fed can monetize that, can literally give money to the fiscal side to enact fiscal action. So I think the two are somewhat one and the same when you have this much debt. The Fed cannot allow the system to collapse. They've enabled all this debt over the last several decades. Governments have no reason to be disciplined in rating in that debt, especially in a democracy where that's how you get voted in, by offering more, right, against the future, which is really borrowing. And under that scenario, you kind of have to keep rates low, because if the Fed doesn't keep rates low, how are you going to possibly handle that interest cost on the government debt side? So while they are, in legally separate structures, I think in practice it's all one and the same.
So another question, and I'm more comfortable speaking about Keynesianism, right, and fiscal stimulus,
Yeah.
and the idea of in a depression or in a recession, you invest big and then you pare back. And what I'm curious to hear your thoughts on are if maybe the problem is not so much the current environment, because there is something where you need, as you've said, in terms of not being anti-Fed in short term, there's a lot of necessity out there, and this is so unprecedented. But at the same time, if we were coming down from 4% interest rates or 5% or whatever, if we were coming from a balanced budget, whatever you want to say, do you feel that that's part of the issue, is that we never do get back to it's hard for the inertia in the last 20 or 30 years has been towards maintaining the deficits and maintaining low rates and that sort of thing?
Yeah, and I think this is why it does worry me a lot how it's going to look coming out of this. We don't know what global debt is going to look like by the time this is all over. Mm. I haven't looked at the global debt to GDP numbers. I am sure it's spiking, and it's probably going to spike even further. Now, you could say, well, that doesn't matter because everyone else is borrowing, and this kind of goes to this currency war discussion, right? How do you resolve sort of all of this debt when everyone's printing their own currencies left and right? You don't. And I say you don't, and this kind of relates to this theme I've been putting out there on Seeking Alpha in the Legal Ag report, that inevitably, I think what we're seeing here is something that may be more shocking than the virus itself, which could be a recession/depression by all metrics, and a stock market that just keeps going up, that's almost in a bubble. That you have this, as I said recently, sort of the greatest disconnect between stocks and facts on the ground and the economy in history. And that's what fiat systems and that's what all of this debt is enabling. That's what governments are also enabling. And it kind of goes back to this point of the Fed, I think, creating longer term problems. We're arguably not just adding on more debt, we're about to accelerate the wealth gap in ways we've never seen. Mm-hmm. Right? Because of all of this central bank and because of all this fiscal action. And maybe that's an argument for gold as a play on discipline. Maybe it's an argument for Bitcoin. I don't know. But I very much worry about, what happens after this. And I think there is a chance that, yes, you could have, as extreme as it sounds, maybe a low probability, but you do have a probability there of at least for a moment in time, a hyperinflationary type of setup, which is something also I've been kind of bringing up in recent writings, more of as a thought experiment, but you could never grow your way out of all of this debt before this. Now we just tacked on a whole bunch of new debt. Mm-hmm. How I talk about Keynesian and how do you get rid of that debt? It's either you pay it back or you inflate it away. So my worry is that, coming out of this, you do have some very nasty inflationary type of behavior, at least for a moment in time. And the caveat there is I tend to be more of a deflationist in my thinking. I actually think deflationary macro headwinds are much more powerful than any amount of dollars the Fed prints. But for a moment in time, I could easily see a nasty scenario where you have a bubble in stocks, hyperinflationary type of behavior, because all this money is sloshing around in the markets. And the only solution from the Fed and fiscal side to any problem is to do exactly what causes the problem, which is more debt.
Right. Yeah. I mean, it is, and that's sort of where I was coming from. If you had a more stable baseline before this started,
Right.
perhaps there's a different scenario. Perhaps there's more margin for safety in the stock investing term. But what I wanted to sort of as a last question for you is your service focused on market indicators, and you've kind of talked about this potential disconnect between the economy and the market. So what market indicators are you looking at, and what are you seeing right now? What's the weather right now?
Yes. So every week in the lead lag report, I put out a signals report, which outline the signals that are what are documented in those four award-winning white papers I referenced earlier, which tell you about the weather, right? And the four main indicators are the behavior of utilities, treasuries, the ratio of lumber to gold, and then the moving average, primarily the 200-day. And the finding in all those papers, again, is that each of those tell you about conditions of favor and accident, not necessarily direction of markets, but just higher volatility in markets. On a and every week this is updated. It's based purely on market price movement. All I'm doing is giving voice to those indicators. It's not my opinion. It's exactly what market prices are dictating. And I can show you in the spreadsheet that this stuff has predictive power over time. So, the signals have thankfully gotten a lot of this right. And it's also consistent even with the ATAC Rotation Mutual Fund that I run. Signals went risk off end of January. I notified subscribers in there about that because utilities and treasuries were strong. Avoided the entire coronavirus crash. I was able to largely go risk on in the fund, off of the low, and I was alerting subscribers that there was a change in some of the short-term weather suggesting it was okay to speed up. Here, I think it's tricky. The indicators are still largely risk off, but I find it hard to believe or to be subjectively convinced either way that we're in a definitive risk on or risk off cycle for the next several months. Because no different than construction spending on a house, or no different than doing any construction project on a house, it always takes longer and costs more money than you think. I think coming out of this, it's the same kind of deal. This is initial euphoria because the marketplace realizes the Fed is going to socialize losses and it's going to be the buyer of last resort, not lender, the buyer of last resorts in risk assets. But against that backdrop, we have earnings that are just coming out, which are going to be ugly, economic data, which is ugly. And I think the reality that this is going to take some time in the absence of a vaccine. Yes, I'm in New York. They're talking about fining people for not having masks on when they go outside. I'm sorry, even though you may feel it's okay, like the economy is restarting because you can actually go out, and just have a mask when you go out, there are still psychological negatives to seeing people around you wearing masks. It's not a comfortable feeling when you're shopping for clothes at a local retailer and only 10 people can go in that store, and all those 10 people, by the way, have to wear a mask. I've been making that point on Twitter at Lead Lag Report is the handle, that there are a lot of psychology studies that show that the mouth is so critical to the fight or flight response. There are a lot of studies that show that people that smile tend to be seen as safer, more attractive, versus those that don't, who are seen as more dangerous, that cause people to tense up. Well, now you can't even see that because of masks. So, it may seem like, we're on the path to normalcy, but I think this is going to take time. And if it's going to take time, it's against this push and pull of the Fed providing that backstop, and then the realization that, unless it really is a bubble, which I think is a possibility, it's hard to get too excited.
Right. I mean, it's interesting because we're recording this on Friday, the 17th. The market is, as I look, about 1.5% up, the S&P, and we had the remdesivir news yesterday from Gilead,
But
and there's just all these sort of green shoots, and we're going to get out of this. But yeah, I think there's still an expectation that normal is going to return a lot sooner than what we're used to normal. And there's going to be, I suspect, a lot more sand in the gears as far as the economy, as far as even potentially long term, right? Potentially manufacturing comes home for certain goods or whatever. Like there could be some more enduring things out of this. When we talked about, you said tactical is your style. What sort of time frames are you focused on in all this? Are you looking at just week to week? Are you trying to do an analysis for the rest of the year, or how do you sort of deal with that?
Yeah, it's a good question. So in the lead lag report, it's broken down by short, intermediate, and long term because the indicators kind of have different time frames. I will tell you, I much more am a believer in short term than long term. As Yogi Berra once said, predicting is hard, especially about the future. And I always make this point that there are a lot of studies that look at the business of forecasting and the industry, the profession that is the most accurate at predicting the future. This is again shown from independent studies. The most accurate predictors are weathermen. I mean, this is just fact, right? Of every domain that deals with business forecasting, weathermen have been shown to be the most accurate in their domain. The caveat there is only 3 days out in 10-day forecast. Right. So if you go out further than 3 days, if it's Monday and you're worrying about rain on Saturday, it doesn't matter. It's pointless. So if the best anybody can do is predict 3 days out in time, how can you possibly know what the very long term holds? Right. I think that's it. So it's more of a sort of a philosophy for me. So certainly in my mutual fund, it's much more short term oriented. In the lead lag report, I try to bring attention to it on a weekly basis as these changes occur. At the end of the day, though, your time frame will also be dependent upon how you typically yourself allocate and trade. I think an important part of this, which is maybe a good way to sort of tie everything together, stop looking at sort of the best strategy for a moment in time or the best tactical approach or asset allocation. I think you have to find the thing which you are most likely to stick to from an individual portfolio construction standpoint. I've kind of been tagged with this quote that I came up being on the road and presenting the CFA chapters all over the country. Your ability to stick to a strategy matters more than the strategy itself. Your ability to stick to a strategy matters more than the strategy itself. And I think that's something that is really important for all investors to really think through in terms of timeframes that they're looking to allocate across asset classes, volatility metrics. People tend to get sucked into this notion of wanting to buy the high flyer and buy and hold. But the problem with buy and hold, as we've seen with time and time again with studies, is that very few people actually hold. You're better off allocating and having a portfolio with investments that you are more likely to stick to, or a strategy that you're more likely to stick to, than to try to chase the time frame or the tactical allocation of the moment.
Yeah, I think we can sort of see what the climate is going forward, and then you have to pick a climate that works for you and that you enjoy.
Correct.
So, okay. Well, Michael Gayed, the lead author of the Lead Lag Report, you can find that on Seeking Alpha Marketplace. Just search for Gayed or Lead Lag Report. And thank you so much for taking the time out of your day to speak with me. I hope you continue to stay safe out there and also stay safe with your investing. And thank you for coming on.
No, I appreciate it. Thank you all.